After spooking investors in February with his premonition about the markets crying sell, Michael Burry and his Scion Capital Fund have surprised everyone by doing exactly the opposite in the first quarter of the year. In this video, we will see where the legendary investor has invested in this first half of 2003 and whether he is actually making money from his investments. A few days ago, the so-called 13Fs, the forms that funds managing more than $100 million in capital are required to turn in each quarter to the SEC, came out. The Securities Exchange Commission, the body that regulates financial markets in the United States. Obviously, these forms are a great resource for us investors since they allow us to peek inside the portfolios of the financial sharks, even according to the limitations. In fact, institutional funds have 45 days from the last day of the quarter to turn in this form, and they usually turn it in very close to this deadline precisely to avoid revealing their strategies. That is why the forms of major investors such as Warren Buffett with Berkshire Hathaway or Ray Dalio's Bridgewater were all turned in by mid-May. Another limitation of these forms is that institutional investors are obliged to disclose upside trades and trades held in their portfolios but have no obligation to disclose their downside short positions. But let us come to Michael Burry's Scion Capital. As we said at the beginning, after trolling everyone with its sell writing at the beginning of the year, in the first quarter of the year, it made several purchases on Wall Street. From January 1 to March 31, Burry increased his exposure to two Chinese stocks that he had already started buying in the last quarter of 2002. I am talking about Alibaba and JD.com. In Alibaba, Burry doubled his exposure from a $5 million position to $10 million for a total of 100 shares. In JD, on the other hand, Michael Burry invested a total of about $7.5 million, bringing his total position to over $10 million. His total exposure to Chinese securities represents 20% of his portfolio. In the 13 of the memo form we just discussed, however, the dates of purchase are not indicated, so we cannot know exactly whether at this time these positions are idle or passive. What is certain, however, is that Alibaba reached a very important low at $63 per share in November last year, at least 80% from the all-time highs marked in 2020. This low was marked precisely during the period when Michael Burry bought. Share prices then fluctuated between $80 and $120 from January until April of this year period when Burry's second purchase was made. The success of these transactions then will depend on the future performance of the Chinese tech sector. This sector, after reaching peaks of plus 90%, is now traveling about plus 40% from the lows of last November and at about the same prices as in January. Michael Burry's second bet for the quarter is even more sensational. This time, in fact, the investor did not contradict himself, and after tweeting about the crisis in the banking sector a few days after the failure of Silicon Valley Bank, declaring that in his opinion the crisis would be over in a few days, he bought as many as 8 financial sector stocks, including 7 regional banks, bringing his total exposure in the financial sector of his fund to 24%. Of all of them, the most sensational purchase is that of First Republic Bank. We do not know whether Burry then sold less shares in the bank by May 1, the day the bank failed, but in any case, it is very likely that he cashed in. Quite a loss, since from the 9th of March to the 28th of April, last day of trading on the stock market, the stock marked an incredible minus 97%. The second purchase in the sector that has the resounding is PacWest Bancorp, another bank that has been on the verge of bankruptcy this month. Again, unless Michael Burry sold the shares of this bank at the peak in the March 13th spike, a very unlikely event since that very day trading was halted on this stock several times, his position should still be at a loss. In this case, Burry has been luckier since just in the last few days the stock has been running upward again as the bank has managed to shed $6 billion in assets and improve its profitability ratios. In general, however, we can say that even this investment is unlikely to be positive as of today, given that the regional bank index is still below the March 31 prices. Last noteworthy transaction completed by Michael Burry is the purchase of 100 shares of Zoom for a total of about $7 million, 7% of the portfolio. Again, the investment for the time being does not seem to be particularly positive despite the good performance of the Nasdaq since the beginning of the year. Despite the plus 25% of the Nasdaq in these first 6 months of 2003, Zoom Video has underperformed the index by 30%, marking a minus 6% in the first half of the year. After these trades, Michael Burry's portfolio is one of the most concentrated among U.S. managers with far less diversification than, for example, Warren Buffett's Berkshire Hathaway, famous in turn for holding few stocks in their portfolios. Just think that as of today, Sean Capital holds only 21 shares versus Berkshire Hathaway's 48. So it is not shaping up to be a stellar quarter for Burry, despite the fact that the U.S. indices have put up good performances with the Nasdaq we saw at plus 25% and S&P 500 at plus 10. If you're interested in learning about any particular updates from any major U.S. or even foreign investors, let us know in the comments. So we'll go peek into their positions thanks to our Bloomberg terminal.